Alright, let me paint a picture for you. Imagine holding an entire bank in your pocket, where paying for groceries, recharging your phone, or even booking a movie ticket takes just a few taps on your screen. Now, rewind a few years, and welcome to the world of Paytm, India's pioneer in digital payments. It wasn't just an app, it was a revolution, changing the way millions of people handled money every day. But, as the saying goes, the bigger they are, the harder they fall. What led this tech giant to stumble? Stick around, and we'll dive deep into Paytm's fascinating journey, from its meteoric rise to the missteps that led to its downfall. Welcome to the AI Lib. Paytm's journey started with one man, Vijay Shekhar Sharma. Born into modest beginnings in Aligarh, a small town in India, Sharma's early years were anything but extraordinary. In a country where English is often seen as a key to success, Vijay struggled to grasp the language until he was 15. But this challenge didn't slow him down. Determined to rise above his circumstances, he pushed through, attending a local government school and eventually securing a spot at the prestigious Delhi College of Engineering, now Delhi Technological University. While many of his peers aspired for stable, well-paying jobs after graduation, Sharma had a different vision. He wasn't content with following the traditional path. Instead, he sought out ways to create something new, something that would make a lasting impact on India's growing tech scene. His first major venture was indiasite.net, a simple website directory. In the late 90s, the internet was still a nascent concept in India, and Sharma's project was a modest success. When he sold it for $1 million, this marked the first chapter of his entrepreneurial story. But Sharma wasn't about to stop there. Armed with newfound experience and capital, he founded 197 Communications in 2000. Initially, 197 focused on providing mobile content like news and cricket scores via SMS, services that were quite popular at the time. But as smartphones and mobile internet usage started to take off in India, Sharma knew the landscape was changing. He wanted to do more than offer digital content. He wanted to transform the way Indians paid for goods and services. And that's where the idea for Paytm began to take shape. In 2010, with a $2 million investment from 197 Communications, Sharma officially launched Paytm. The platform's initial offering was fairly basic, a prepaid mobile and DTH recharge service. But even in those early days, Sharma had a grander vision. He didn't just want Paytm to be a recharge service. He wanted it to be a complete digital payment solution that would allow users to pay for everything, right from their mobile phones. But in a country where cash was king, this was a tall order. Could Paytm truly revolutionize the way people transacted? As Paytm began to grow, it became clear that Sharma's vision was not just ambitious, it was perfectly timed. India's smartphone revolution was underway, with millions of people gaining access to mobile internet for the first time. The rapid adoption of smartphones, coupled with the rise of affordable data plans, created the perfect environment for a mobile-first solution like Paytm to thrive. In the early years, Paytm focused on its core offering of mobile and DTH recharges. These services were essential to a large portion of India's population, and Paytm made it incredibly easy to top up prepaid accounts. This simplicity was key. No longer did users need to visit a physical shop or kiosk to add balance to their phones. Instead, they could do it from the comfort of their homes, with just a few taps on their screens. This convenience quickly attracted millions of users to the platform. But Sharma wasn't content with Paytm being just a recharge service. In 2013, Paytm expanded into digital payments, allowing users to pay for postpaid mobile bills, landline bills, and even electricity bills using the app. This marked the beginning of Paytm's transformation into a full-fledged digital payment solution. The company's motto, Paytm Karo, use Paytm to pay, began to resonate with users as they saw the value in having all their payment needs handled through one simple platform. Then came the real game changer, the Paytm Wallet. Launched in 2014, the wallet allowed users to store money digitally, which they could then use to pay for a variety of services. The Paytm Wallet was initially met with skepticism. After all, Indians were used to dealing in cash. But it didn't take long for the wallet to catch on, especially as more and more services began accepting Paytm as a valid payment option. The wallet's popularity skyrocketed when major companies like Indian Railways and Uber began integrating Paytm as a payment method. Suddenly, users could pay for their train tickets, rides, and even utility bills, all with a few taps on their phones. By the end of 2015, Paytm had over 100 million registered users, and it was clear that the platform was on the verge of something big. But as we'll see, Paytm's true breakthrough was just around the corner. 2016 was a turning point for Paytm and, quite frankly, for the entire Indian economy. On the evening of November 8, 2016, India's Prime Minister, Narendra Modi, made a surprise announcement: the demonetization of the country's 500 and 1,000 rupee notes. These notes accounted for more than 85% of the currency in circulation, and their sudden removal from the economy created a massive cash crunch. Overnight, millions of Indians found themselves with worthless cash in hand and few alternatives to make transactions. In this chaos, Paytm emerged as the unlikely hero. With physical cash in short supply, people turned to digital payment solutions, and Paytm was one of the most accessible options available. The company was quick to capitalize on this unprecedented opportunity. Within hours of the demonetization announcement, Paytm launched an aggressive marketing campaign, positioning itself as the solution to the country's cash woes. Its now famous tagline, "Ab ATM nahin, Paytm karo," now, "Don't use ATMs, use Paytm," struck a chord with millions of Indians who were scrambling for alternatives to cash. The timing couldn't have been better. Paytm's QR code-based payment system, which allowed users to scan codes at local shops and pay directly from their wallets, became a lifeline for small businesses and street vendors. Previously reliant on cash transactions, these merchants quickly adopted Paytm as a way to continue doing business without physical currency. Auto rickshaw drivers, vegetable vendors, and even mom-and-pop shops started displaying Paytm QR codes, and consumers followed suit. Within a matter of months, Paytm's user base exploded. By the end of 2016, the company had registered over 200 million users, cementing its position as the dominant player in India's digital payment space. Demonetization had turned what was once a niche platform into a household name. But while Paytm's rise seemed unstoppable, the seeds of its future challenges were already being sown. As we'll see in the next section, rapid growth came with its own set of problems. While Paytm was expanding at an unprecedented pace, cracks were beginning to appear in its foundation, and these cracks would soon become too large to ignore. As Paytm continued its meteoric rise, it set its sights on what many tech companies see as the ultimate milestone: going public. In 2021, Paytm announced plans for an initial public offering, IPO, and expectations were through the roof. After all, this was a company that had revolutionized the way Indians handled money. Investors were eager to get in on the action, and the IPO was billed as India's largest ever. In November 2021, Paytm officially launched its IPO, raising approximately $2.3 billion at a valuation of $20 billion. The company's shares were priced at 2,150 rupees, and there was considerable buzz surrounding the offering. Big-name investors like Alibaba, SoftBank, and Ant Group had backed Paytm in its early days, and now they were poised to cash in on what seemed like a guaranteed success. But as trading began on November 18th, things didn't go as planned. Despite the high expectations, Paytm shares opened at 1,950 rupees, a nearly 9% drop from the initial offer price. By the end of the day, the stock had plummeted to 1,560 rupees, a 27% decline in just one day of trading. The IPO, which was supposed to be a crowning achievement for Paytm, quickly turned into a disaster. Over $5 billion in investor wealth was wiped out in a single day, and the company's stock continued to struggle in the following weeks. So, what went wrong? While there were several factors at play, one of the key issues was that Paytm's business model wasn't as solid as many had hoped. Despite its massive user base and transaction volume, the company was still bleeding cash. Investors had long been concerned about Paytm's ability to turn a profit, and these concerns only grew as the company continued to expand into new, often unrelated, services. As the dust settled on Paytm's disastrous IPO, the company was left with some hard questions. Chief among them was profitability. Despite its impressive user base and its position as a leader in India's digital payments market, Paytm was still far from being a profitable business. This wasn't exactly a secret. Investors had long been concerned about the company's financial health. Paytm had been spending aggressively for years, pouring money into expanding its services and acquiring new users. But this growth at all costs strategy was starting to show its limits. One of the key issues was that while Paytm had successfully gotten millions of users to adopt its platform, its revenue streams weren't as strong as they needed to be. The company earned a small commission on transactions made through its platform, but this alone wasn't enough to cover its massive operating costs. On top of that, Paytm had diversified into so many different services, everything from selling movie tickets to insurance, that it wasn't clear where the company's focus lay. Was Paytm a digital payments company? A financial services provider? An e-commerce platform? The answer seemed to be all of the above, and this lack of focus made it difficult for the company to scale any one part of its business profitably. Investors and analysts began to question whether Paytm was spreading itself too thin. Rather than concentrating on its core digital payments business, the company appeared to be chasing growth in every possible direction, often at the expense of profitability. And while diversification can be a strength, in Paytm's case, it was starting to look more like a liability. One area where this was particularly evident was Paytm's lending business. The company had begun offering loans to consumers and small businesses through its platform, hoping to tap into the growing demand for credit in India. But lending is a tricky business, especially in a country like India, where access to credit has historically been limited. Many of Paytm's borrowers were first-time credit users, which increased the risk of default. And while the lending business had the potential to be lucrative, it also came with significant regulatory challenges, as Paytm would soon discover. The company's financial troubles were further compounded by its aggressive marketing and customer acquisition strategies. Paytm had spent billions of rupees on cashback offers, discounts, and incentives to attract users to its platform. While these tactics had been successful in growing its user base, they were also unsustainable in the long run. Once the incentives dried up, there was no guarantee that users would continue using Paytm, especially with competitors like Google Pay and PhonePe gaining ground. Despite these challenges, Paytm remained optimistic. In its filings ahead of the IPO, the company had outlined a clear path to profitability, citing its growing user base, increasing transaction volumes, and expanding range of services. But as the post-IPO reality set in, it became clear that Paytm's road to profitability would be longer and more difficult than many had anticipated. Investors were growing impatient, and Paytm's stock price continued to slide, losing nearly half its value in the months following the IPO. One of the key components of Paytm's strategy to become a profitable business was its subsidiary, Paytm Payments Bank. Launched in 2017, Paytm Payments Bank was supposed to be a game changer. It allowed users to open a digital bank account, earn interest on deposits, and manage their money entirely through their mobile phones. For a country like India, where a significant portion of the population still lacked access to formal banking services, this seemed like a revolutionary idea. At first, things seemed promising. Paytm Payments Bank quickly gained millions of users, many of whom were first-time bank account holders. The bank's fully digital nature made it easy for people in remote areas to open accounts, and Paytm's existing user base provided a ready-made market for its banking services. But it wasn't long before regulatory challenges began to surface. In its early days, Paytm Payments Bank found itself in trouble with the Reserve Bank of India, RBI. The central bank had strict rules regarding the operation of payments banks, particularly when it came to compliance with Know Your Customer (KYC) guidelines. KYC is a critical process in banking, as it helps ensure that customers are who they claim to be and helps prevent issues like money laundering and fraud. Unfortunately, Paytm Payments Bank struggled to comply with these regulations. In 2018, just a year after launching, Paytm Payments Bank was hit with a regulatory strike from the RBI. The central bank temporarily halted the opening of new accounts, citing non-compliance with KYC norms and other operational issues. This was a major setback for Paytm, as its payments bank was one of the key pillars of its long-term growth strategy. While the company quickly submitted a compliance report and had the ban lifted by the end of the year, the damage was done. The RBI's intervention had raised serious questions about Paytm's ability to manage its banking operations effectively. But this was just the beginning. In 2021, the RBI imposed a fine of 1 rupee crore on Paytm Payments Bank for submitting false information. This was a significant blow to the company's reputation, as it called into question the transparency and accuracy of its reporting. The issues didn't end there. By late 2021, the RBI found more violations, including lapses in technology, cybersecurity concerns, and allegations of money laundering. One of the most concerning issues was the lack of separation between Paytm Payments Bank and its parent company, 197 Communications. This lack of a clear divide between the bank and the rest of Paytm's operations raised red flags for regulators, who were concerned about the potential for conflicts of interest and the misuse of customer funds. As a result, the RBI ordered Paytm Payments Bank to stop onboarding new customers and called for an external audit of the bank's operations. The audit revealed even more problems, including serious lapses in KYC compliance. In some cases, a single identity proof was linked to thousands of accounts, raising concerns about the potential for fraud and money laundering. Transactions in some of these accounts ran into the crores, far exceeding the regulatory limits for payments banks. By 2023, the situation had become untenable. The RBI had issued multiple warnings and imposed fines, but Paytm Payments Bank had failed to address many of the issues. In October 2023, the RBI slapped another fine on the bank, this time worth 5.3 rupees crore. This was the final straw. In early 2024, the RBI delivered a crushing blow. Paytm Payments Bank was banned from all banking activities. The bank was effectively shut down, leaving millions of users scrambling for alternatives and casting a long shadow over Paytm's future. As Paytm Payments Bank faced its regulatory challenges, the broader company was also grappling with its own set of problems. The company's rapid expansion into various sectors, digital payments, e-commerce, financial services, and even entertainment, had stretched its resources thin. While diversification had helped Paytm grow quickly in the early years, it had also created a sprawling, unwieldy business that was difficult to manage effectively. One of the biggest criticisms leveled at Paytm was that it lacked a clear focus. While its core digital payments business remained strong, the company had expanded into so many different areas that it was difficult to tell what its main priorities were. Was Paytm a payments company? A financial services provider? An e-commerce platform? The answer seemed to be all of the above, and this lack of focus made it difficult for Paytm to scale any one part of its business effectively. The company's lending business, for example, had the potential to be a major revenue driver, but it also came with significant risks. Many of Paytm's borrowers were first-time credit users, which increased the likelihood of defaults. At the same time, Paytm's foray into e-commerce had not yielded the kind of success it had hoped for. Competing with giants like Amazon and Flipkart proved to be a tough battle, and Paytm Mall, the company's e-commerce platform, struggled to gain a significant foothold in the market. As these challenges mounted, Paytm's financial performance began to suffer. Despite its massive user base and the billions of transactions processed through its platform, the company was still losing money. Investors, who had once been enamored with Paytm's growth story, were growing increasingly impatient. The stock, which had already taken a hit after the IPO, continued to decline, and by 2023, it was trading at less than half of its original listing price. One of the most striking aspects of Paytm's decline was the sharp shift in investor sentiment. In the lead-up to the IPO, investors were filled with optimism about Paytm's future. After all, the company had a massive user base, processed billions of transactions every month, and was backed by some of the biggest names in tech investment, including Alibaba's Ant Group and SoftBank. Paytm was seen as a symbol of India's digital transformation, and many believed it was only a matter of time before the company turned its massive scale into profitability. However, as Paytm's stock continued to falter after the IPO, investor confidence began to wane. The initial enthusiasm was replaced by a growing sense of doubt, and questions about the company's long-term viability became more pronounced. One of the main issues was Paytm's inability to generate profits, despite its impressive growth. While the company had successfully attracted millions of users to its platform, it hadn't yet figured out how to make its business model sustainable. At the heart of this problem was Paytm's reliance on burning cash to acquire users and drive transaction volumes. In the early days, this strategy had worked wonders, as the company quickly became the dominant player in India's digital payment space. But as competition from rivals like Google Pay, PhonePe, and others intensified, Paytm's growth began to slow. The cashback offers and discounts that had once attracted users were no longer enough to keep them loyal to the platform, especially as competitors rolled out similar incentives. Another factor that contributed to the growing investor unease was the increasing complexity of Paytm's business. The company had expanded into so many different areas that it was difficult for investors to get a clear picture of where the growth opportunities actually lay. Paytm was involved in digital payments, e-commerce, lending, financial services, insurance, gold trading, ticket booking, and more. While diversification can be a strength in some cases, in Paytm's case, it created confusion. Investors were unsure whether the company was a fintech firm, a tech company, or something in between. As a result, many investors began to question whether Paytm had a coherent strategy for the future. This uncertainty was reflected in the stock price, which continued to decline in the months following the IPO. By early 2023, Paytm shares were trading at less than half of their original value, and the company had lost billions in market capitalization. For a company that had once been hailed as a unicorn and a symbol of India's digital revolution, this was a dramatic fall from grace. But while investor sentiment was clearly turning negative, Paytm's management remained optimistic. The company insisted that it was on the path to profitability and that its investments in new services would pay off in the long run. Paytm pointed to its growing user base, the increasing adoption of digital payments in India, and its expanding portfolio of financial services as reasons for optimism. However, for many investors, these promises felt like too little, too late. While Paytm had been the pioneer in India's digital payments landscape, it was far from the only player. Over the years, the competition had become increasingly fierce, with major global and domestic players entering the market. Two of the biggest competitors that emerged were Google Pay and PhonePe, both of which began to challenge Paytm's dominance in significant ways. Google Pay, launched in India in 2017, leveraged Google's immense technological expertise and global reach to quickly gain traction. The app was simple to use, had a sleek design, and integrated seamlessly with the Unified Payments Interface, UPI, a real-time payment system developed by the National Payments Corporation of India. UPI allowed users to make instant, interbank transactions directly from their bank accounts, without needing to store money in a separate digital wallet like Paytm. This made Google Pay especially attractive to users who could now make payments without the extra step of loading funds into a wallet. PhonePe, which was backed by Walmart-owned Flipkart, also began making significant inroads in the market around the same time. Like Google Pay, PhonePe was built on UPI and offered a range of services that mirrored Paytm's, including payments, recharges, and bill payments. However, PhonePe also had the advantage of being closely integrated with Flipkart, one of India's largest e-commerce platforms, which gave it access to millions of potential users and merchants. These competitors didn't just eat into Paytm's market share. They also changed the dynamics of the digital payment space. Google Pay and PhonePe both focused heavily on user experience, making their apps more intuitive and easier to navigate. They also began offering cashback and rewards programs similar to Paytm's, which helped them attract users who had initially flocked to Paytm for its discounts. As a result, Paytm found itself in a difficult position. It had built its business on the back of cashback offers and wallet payments, but the rise of UPI-based apps like Google Pay and PhonePe made its wallet service less relevant. Many users began to prefer the direct bank-to-bank transactions offered by UPI, which were faster and didn't require them to store money in a separate digital wallet. This shift in user behavior hit Paytm hard, as the company had invested heavily in its wallet infrastructure. In response, Paytm tried to adapt by integrating UPI into its platform and expanding its range of services. The company launched Paytm Money, an investment platform that allowed users to buy mutual funds, stocks, and gold. It also entered the insurance market and began offering loans to small businesses. However, these efforts were met with mixed success. While Paytm continued to grow its user base, it struggled to match the rapid growth of Google Pay and PhonePe. The closure of Paytm Payments Bank by the Reserve Bank of India in early 2024 was a turning point, not just for Paytm, but for the broader fintech ecosystem in India. This wasn't just a regulatory slap on the wrist. It was a full-blown crisis. Paytm, which had once been seen as the flag bearer of India's digital payments revolution, was now facing an existential challenge. Millions of Paytm's users, particularly its 40 million merchants, suddenly found themselves in a difficult spot. For years, These small businesses and shop owners had relied on Paytm Payments Bank to handle their daily transactions, from receiving customer payments to managing their working capital. Now, with the bank shut down, many were forced to migrate to competing platforms like Google Pay and PhonePe, both of which were quick to capitalize on Paytm's misfortune. For Paytm, this was more than just a loss of customers. It was a blow to its reputation. Trust is the cornerstone of any financial institution, and Paytm had spent years building trust with its users by promising a convenient, reliable, and secure way to manage their money. The repeated regulatory violations and the eventual closure of its payments bank shattered that trust. For many users, the message was clear. Paytm was no longer a safe or reliable option. The company's lending partners also began to distance themselves from Paytm. With the RBI's ban in place, many banks and financial institutions were hesitant to continue their relationships with Paytm, fearing that their association with the embattled platform could tarnish their own reputations. This further compounded Paytm's financial woes, as the company had been relying on its lending business as a key source of revenue. Internally, the company was facing a leadership crisis as well. Founder Vijay Shekhar Sharma, once hailed as a visionary, now found himself under intense scrutiny. Shareholders, investors, and employees alike were questioning the decisions that had led to Paytm's downfall. Sharma had always been known for his ambition, but many now saw his relentless drive for growth as reckless. The company had expanded too quickly, diversified too broadly, and failed to address the cracks in its foundation. Externally, Paytm attempted damage control, issuing statements assuring users and investors that it was taking steps to address the regulatory concerns. The company emphasized that it was working closely with the RBI to rectify the issues at Paytm Payments Bank and would be taking a more conservative approach moving forward. But the damage had already been done. Paytm's once unstoppable momentum had been brought to a grinding halt. Despite these challenges, Paytm wasn't completely out of the game. Its core digital payments business still had millions of active users, and the company continued to process billions of transactions every year. However, its days as the undisputed leader of India's fintech sector were over. The rise of competitors like Google Pay and PhonePe, combined with the regulatory crackdown, had left Paytm fighting for its survival in a rapidly changing market. Paytm's fall serves as a cautionary tale for tech companies everywhere. It's a story of how a company that once seemed unstoppable was brought to its knees by a combination of overexpansion, regulatory missteps, and fierce competition. As Paytm struggled to regain its footing, it became clear that success in the tech world isn't just about innovation. It's about staying grounded, following the rules, and never taking your eye off the fundamentals. So, what do you think? Can Paytm recover from its fall, or is this the beginning of the end for India's fintech giant? If you enjoyed this video, please give it a thumbs up, subscribe to the channel, and hit the bell icon so you don't miss any future updates. Check out the videos appearing on your screen right now for more insights and stories from the world of technology. This is the AI Lib. Stay tuned.